Thank you.
Hi, everyone. Thank you very much for joining us for this online Geneva Trade and Development workshop. The series is organized jointly by the CEPR, the Geneva School of Economics and Management, the Geneva Graduate Institute, UNCTAD, and WTO. For today's seminar, we are delighted to welcome Kala Krishna from Penn State University. Kala will be presenting her paper, Learning to Use Trade Agreements, which is joint work with Carlos Salamanca, Yuta Suzuki, and Christian Volpe Martinkus. Today, we're also very fortunate to have Yuta and Christian joining us for the discussion and perhaps for answering some of the questions from the audience. As usual, the session will last for 1 hour and 15 minutes. For the first hour, Kala will be presenting her paper, and the final 15 minutes will be devoted to Q&A. During Kala's presentation, you can type your questions in the Q&A window, and we will pass them on to Kala at suitable junctures in the talk. And in the Q&A, the audience can just raise a hand by clicking on the raise hand button, and then we will ask you to unmute yourself and address Kala directly. I think I covered everything. Kala, again, thank you very much for being here. We are super happy to host you. The floor is yours for 1 hour.
Thank you. And thank you very much for inviting me. I'm very happy to be here, and it's a pleasure to see everyone again. My slides are being shared, or I need to share them?
Yeah, you need to share screen. Yeah.
Okay, excellent. All right, so I'm assuming everyone can see the slides now. Tell me if there's a problem. Okay. All right, so this paper started sort of because we had we were talking, and I was talking with Christian, and Christian was telling me about his the data that they had at the Inter-American Development Bank. And as we started talking, we realized that we could actually say something about how preferences are used because of this marvelous data that he had at the Inter-American Development Bank. And a puzzle that sort of people have seen in the past is trade agreements are there, free trade areas. You have zero tariffs in a free trade area, yet you have the choice of invoking preferences and getting zero tariffs or not. And very often, exporters do not invoke these preferences. They just say, okay, we'll pay the tariff. And it's been a bit of a puzzle. And people say, well, there must be some costs associated with it. And that's why they don't want to do it. But what are these costs? And how do we measure them? And what is their shape? And that's what this paper is all about. So, for example, with the EU, in the UNCTAD reference here, 67% for EU exporting to countries with FTAs, they didn't invoke them. So, they only invoked them for 67%, the rest they didn't. In some earlier FTAs, fraction of transactions invoking preferences was extremely low, sometimes 30%. Well, rules of origin need to be met in order to invoke preferences. And these rules of origin, they're basically the heart of the FTA. After 200 pages of the treaty, rules of origin. And they have two kinds of costs. So first you have this marginal cost, because to meet rules of origin, you have to make the product in a particular way, either some transformation or you have to use some particular inputs. And of course, when you restrict what you can do, you're going to raise costs. So marginal costs rise. And secondly, they're fixed costs. What are these fixed costs? Well, if you have to buy your inputs from particular people, then you have to change your suppliers, your supply chain. That's a one-off cost. You also have to learn how to deal with all the documentation, how to get the information that you need in order to fill those documents out also. And I'll tell you more about this in a minute. So in this paper, we're looking at these fixed costs, and we're arguing that these fixed costs may decline with experience as firms learn. So do they actually decline? And we do this by looking at the shape of these fixed costs. So what is the shape? What do we mean by the shape? How do we figure out the shape? And that's what I'm going to tell you about. So just before that, let me just show you what kind of documentation you have. You have to fill in this kind of a form. They have to show that, they have to fill in this form for every transaction. You need to know the rules of origin that you comply with. You need verification. You need to provide information on inputs in the production process. Lots of details. Here's some examples with other countries. So, for example, Vietnam, it's this quote sort of gives you an idea of what you need to do. You have to find this, then they screen it, then every shipment has to be put in to the export-import managing department, then it has certifying letter and commercial invoice and customs declaration. I mean, it's nuts. But I always think that the next slide this quote gives you a very good idea. So in Thailand, it tells you about, what you need to be when you're an automobile producer. So if you're making a car, you want to invoke preferences. What do you need? You need to certify everything in there meets rules of origin. So if there are 1,000, 2,000 parts in a completed vehicle, you have to conduct the documentation for every supplier. I mean, imagine what a pain this is. And you have to do this for every transaction. Luckily, if you have the same supplier, then this will become much easier. So this is the kind of cost that we're talking about. And there is a literature on this. Okay, so let me make sure that I tell you what that is. And there's it's been well understood, let's put it like this, that rules of origin can provide hidden protection. What do we mean by hidden protection? Well, if you can count something in the free trade area for origin and you can't count something outside, you'll buy the input from the free trade area, even if it's more costly. Well, if that isn't protection, I don't know what is. So this is sort of what the earlier work, some of it by me, pointed out. And I was fortunate to work with Anne Kruger on early work on this. Then there's been work on the cost of using these trade agreements. And it's sort of agreed that this is the right way to model it, that there do increase marginal costs and there are some fixed costs in here. Also, there's more recent work showing how firms differ in terms of their choices to meet rules of origin. It should be quite easy and intuitive to understand that because there are these fixed costs, just like export costs, more productive exporters meet rules of origin. This is what's shown in the paper with Demidova, that they're sorting, and Demidova and Key, and then the paper with Ivan Cherkashin is one of the early ones to take the rules of origin seriously and put them into a structural model and estimate the effects for policy. So try to get some idea of where you should intervene. More recent literature, and Mark Mellitz has a really nice paper on this recently, look at NAFTA and argue that rules of origin can backfire after a point. And that makes sense because once you make the rules of origin more and more restrictive, you can just say, okay, go away, I'm not going to use you anymore. And so protection to domestic inputs after a while will just backfire. Konkani shows very clearly that rules of origin in NAFTA did provide hidden protection for intermediate goods. And I think these are the two most recent papers on this. Okay. So what do we do and what's our contribution to the literature? Well, first we construct this novel data set, and it's something we're planning to use in a lot more work. So I'll tell you at the end about what else we're planning to do. But we basically, with the data that Christian had, we were able to get matched importer-exporter trade data at the transaction level among South American countries. And what's unique and what's very difficult here to do is that it has information on whether preferences are used or not. Also, because we have this over time, we can actually construct histories for each exporter. So we can say, okay, with this transaction, this was your history. This is how much you use trade preferences. This is how much you used it with different importers, with different products, and we can sort of see which kind of experience matters and which one matters more. So this is what we use to provide a way to estimate the shape of fixed costs for exporting firms using preferences. And to the best of our knowledge, we're the first to do so. So although we can't see the fixed costs directly, just like if you're looking at the ground, you won't see the clouds, but you'll see the shadow of the clouds. We don't see fixed costs directly, but we see how they affect behavior. And from that, we back out which ones are more important, which kind of experience is more important, which kind is less important. We show very clearly that fixed costs fall with experience. Now, this is interesting because that means that the problem we've been treating as static, it's universally treated as static, is actually dynamic. And when it's dynamic, then the policy angle changes very much. So very simply, if it's dynamic, if you can put some policy in place right when the free trade agreement starts, that would reduce these costs, make exporters more able to invoke preferences, it's going to have that long-term impacts. If you can boost up utilization from 30% to 80%, wow, you've really done it from now till the FTA dissolves, if that happens. So what do we find? We find that the type of experience matters a lot. And experience from the same product and the same importer is most important. And that's not surprising, right? But there are spillovers to other importers with the same product. So if I trade with you, Julia, because I'm importing T-shirts, then, with the other importers of T-shirts, it's going to be a little easier. So this is sort of the idea there. Any questions?
Carla, there are no questions from the audience yet, but I had a clarification question on the framing. So this, in particular, this last part seems like all of the dynamics comes in on fixed cost reductions, but I was wondering, it could also be that marginal costs are declining, and I was wondering if the framework that you offer is one that will allow you to separate these two, or if there's something kind of in the nature of the policy that makes kind of dynamics on the marginal costs and dynamics on the fixed cost very distinct.
Okay, so I think there is something in the dynamics of the policy in the sense that, when you're making the product, what are you doing? You have to choose your supply chain. And then once you've got your supply chain that meets the rules of origin, there's very little reason that experience should help you. You've got the inputs, you've chosen the least cost supplier, and then you have your marginal cost, right? So this is something we could empirically look for, but for that, we need a way of estimating the restrictiveness in terms of marginal cost. And as I'll tell you, this is something we're working on in the future. So we don't see any real reason for the marginal cost, but definitely this is something we plan to look at to see whether that's also there with marginal cost.
Great, excellent. Thank you for the clarification. So Laszlo Halpern is asking for a bit more information about who the exporters and the importers in your approach and in your setup are. Perhaps you will cover this in the data section.
Immediately, yes. So the question, what we're looking at is we're looking at Argentina and Peru's exports to Colombia. Why are we doing this? We're doing this because we have great data for Argentina and Peru, and they're big exporters to Colombia. So what we have is for each exporter from Argentina and Peru to Colombia, we have information on how much they exported in value, sometimes also in weight and in numbers, whom they exported to. So we have the match of the exporter and the importer. Then we have information on whether preferences were used or not. And I'll come to that in a minute. I hope I answered your question.
Absolutely.
Okay, any more?
Not for now.
Okay, then I shall keep going. Okay. So the databases that we have are Colombian import data, and these are the dates that they are available from. And I'm going to move this so that this.
Cal, I think you're on mute. Your microphone got muted. We can see your slides, but we cannot hear you yet. So perhaps clicking the microphone on the left bottom corner of your screen.
Did that work?
Yes, correct. Now we can hear you.
Now you can hear me? Okay, very good.
Yeah.
So I'm hoping I can make this again, Control L, full screen. Yeah. All right, you can hear me?
Yes, we can hear you well.
Right, very good. I don't know why it got unmuted. Okay, so question you might ask is who decides whether to use preferences? Well, clearly the exporter, because he's the one who has to provide the proof. How do we know preferences are being used? We need data on the exporter side and the importer side to see if they're being invoked, because you will need to see whether the tariff was paid or not. When might we expect to see preferences used? Well, you'd expect that the exporter will find it worthwhile using preferences if there's a large transaction, because then the gain from the lower tariffs would be larger, and be able to cover the fixed cost. And also in his experience, because we'd expect that fixed costs would be lower then. So here's just a beginning look at the data, which is, how is your experience in past transactions affecting the utilization rate, so the fraction of times that preferences are used. So we have, no experience, that's the bottom curve, and it's relatively flat. It's, if you have no experience, it's about 20% chance that you'll use it. Moreover, it doesn't vary much with the value of the transaction. Let's look at the next one. You have one experience, and now, hey, it's rising with the value of the transaction. It looks like there's a little dip here, but I'm not sure that really matters. Now you have 5 or more experiences. Again, the utilization is still rising, but less steeply with the value of transaction. But the whole curve is above the earlier curves. So it's saying, look, when you have experience, you tend to use it more, and the value of transaction matters less. So that's what you should take away from this picture. The next pattern that we see is that the type of experience matters a lot. For a given level of experience, exporters with experience in the same product use this trade agreement more. So here we have the 3 different curves. The dot is all. So if you have experience 1, you have the utilization probability here. If you have experience in the importer product or product, then for the same experience, your utilization is higher, which means that it's doing more. Okay. So now, this is a little irritating, but to the bottom now, or something like that. I can just, sometimes these things are more irritating than you believe. Okay. So we're assuming the following, that the exporter maximizes his profits in dollars. And this basically has been shown by Gopinath and Stein. It makes sense. Why are you exporting? You're exporting because you want to import. And since most things are quoted in dollars, you want the dollars. Okay. So the second thing that we assume, and I think reasonably, is demand from Colombia as in Colombian pesos, because that's what their currency that they're using. It's not based on dollars. So the peso dollar exchange rate acts like a demand shock. So when the exchange rate, the peso in Colombia appreciates, it's like, hey, I can get more demand shifts out. Okay. We assume that the exporter faces a constant elasticity of demand for the product from each importer in each transaction. So price is going to be our usual constant markup on costs. And since costs differ when your preferences are used or not, the price will differ when preferences are used or not. Okay, so this is how we write it. So your demand depends on whether you're using preferences or not. So it depends on the MFN tariff. And that is applied when you don't use preferences, so when A is 0. Otherwise, it's the FTA tariff, which is applied when A is 1. And then you have the price, which again depends on whether you're using preferences or not, to the power eta, because it's a constant elastic demand curve. And this is your demand shock, which is the exchange rate. This will vanish until we come back to it in the IV section. Okay, all right. So, the logic is very straightforward here. Okay, then what is the profit of the exporter from this transaction? Well, depending on whether he uses it or not, A01, you have a different price. This is the R is the increase in the marginal cost when you use preferences. So if you use preferences, then your cost will be R times C. If you don't use preferences, then this will just be C. And then demand, of course, which depends on the A, because P depends on A, and then minus the fixed costs. So only if you use preferences do you have to pay these fixed costs. And this epsilon is the idiosyncratic multiplicative shock. Multiplicative because this is going to help us with our specification. So it's purely for convenience that we are assuming this multiplicative shock. Okay, so I think I've covered everything here. Yeah. Okay. So when is the exporter going to use preferences? He's going to use preferences if it's profitable to do so. So when profits for the transaction, when you use preferences are more than the profits when you don't use preferences. So that's saying that A is 1 when this is more than 0. Using preferences is more profitable than not using preferences. And what does this mean? Well, we know because of the CES setup that profits are just revenues over the elasticity. From everybody who's read Mellets knows this. And so this has to be more than the fixed cost. Now you start seeing why it's multiplicated. Okay. You can rewrite these revenues when you use preferences versus when you don't as something which is product and time variant. Product time variant, why? Because the cost increase varies by product. The and possibly time. And then you can write it as this thing which varies with product and time, times the difference in the tariffs. So this is like the gain, and then this is the size of the transaction. But notice here it's revenue if you didn't use preferences. So we're going to have a little bit of give here, and I'll talk about this give right at the end of the presentation. So if this is more than the fixed cost, then you use it. And so basically this means that taking logs over here, this is going to be giving you, this is the savings variable. BPT is going to be these fixed effects, product time fixed effects. Log of F is going to be from this side coming over to this side. And then you have this new epsilon, which is the log of the epsilon. So we have our basic setup, which is what we're going to use, comes from this very simple idea. So we're going to look at how the shape of this fixed cost map changes, and by looking at how experience matters in utilization. So this suggests that we use the following equation to estimate things, which is the probability that you use preferences depends on the savings, the fixed cost, and these fixed effects. So what do? We don't see the fixed costs. We substitute for these fixed costs using experience. So the fixed cost depends on experience, and experience of various kinds. So that's our approach. So we are going to decompose the experience in a number of ways. So first, we decompose the experience into 4 kinds. So you can have experience with the same importer and the same product. You can have experience with other importers in the same product, the same importer, other products, or other importers and other products. So this is exhaustive. So we're basically doing a 2-way classification. Think of a box with 2 options: same importer, other importer, same product, other product, and these are the 4 elements in that box. So all those elements sum up to total experience, and we're going to see if the probability that you use preferences varies differently with these things. So what do we do with experience? It turns out that after 5, nothing much happens. So we use dummy variables and use experience up to 5. So experience 5 will become, if the experience you have is greater than or equal to 5, 1 to 4, we go experience 1, 2, 3, 4. So like, for example, if exporter A has 3 experience with the same importer and the same product, then this experience will be 1, and all other experiences will be 0, just to make sure that we understand how it's put into the regression. Okay. The equations look ugly, but they're not. Right? So we're saying the probability that you use preferences depends on these different kinds of experiences and how much you have. And then on these controls, and then an error. And we have the savings, the age of the exporter as controls. We have lots of fixed effects. So all these estimates are within estimates. We control for the exporter, the importer. We have in the paper table that shows, whatever you do, put in whichever fixed effects you want. This part of the estimate is very robust. We have country, product, year fixed effects here. And these betas that we're going to estimate are capturing the learning effects from experience. So the algebra this equation looks ugly, but it's really nothing. So in the paper, we have these horrendous looking tables. They take up the whole page, okay? And we've thought very hard about how are we going to present this. And we decided that this picture was the best way to present an ugly set of, tables. So here's what we did. So what we have here is the round dots are giving you the point estimates of the same. So same importer, same product. So this is saying with experience 1, the same importer, same product, the coefficient is about 0.04 right here. Similarly, with experience rising, it's rising to about 0.06 here, then 0.07 here, and then up here to 0.09 once you have 5 or more experience. The triangles here are other same. So, importer product, so other importer, same product. And these are definitely below this. You have, again, the pattern slightly increasing, but not as much as over here with experience. Moreover, we wanted to show if we're saying this is increasing, is it really increasing? So we decided to show this by connecting these estimates by lines. So you see that we have these intervals. Those are giving you your usual thing. Well, this is significantly different from 0. All of these are significantly different from 0 because these intervals never hit 0. Here, this one is maybe not significantly different from 0, but all the others are. This one is marginally so. Okay. But we wanted to see, is this one different from this one? Well, we connected it with lines. So when it's connected with this smaller dash, come down here, it says the 10% level, they're different. Here, at the 5% level, these two are different. Here, it's not really significant. Here, we're back to the 10%. These not really significantly different from each other. That means it's relatively flat. So this is how we decided this was the best way of presenting what we had visually. With other products, it's not significant. So we didn't bother to put in the other two because we would have just had more lines on here and it wouldn't have gained anything for us. Okay, so any questions again?
Yes, Carla, thank you. There are a couple of questions. So first, one from David Shore. He was asking about who bears the fixed cost of utilizing rules of origin. And the idea is that if an exporter and an importer have a repeated relationship, there could be a possibility of the importer wanting to provide assistance, for example, in these costly actions involved in claiming for preferences. So, so the question is whether this happens, and also whether it happens differentially for product inputs that are more specialized or highly differentiated that might provide even stronger incentives for this kind of cost sharing type of behavior. So this is one of the questions.
Yeah, we haven't looked at this in terms of sort of differentiated products, the products are very differentiated or not. But the way that it's set up, we expect that the exporter is going to pay these costs because, you have to get it through customs. To get it through customs, you have to show that they meet rules of origin. The importer is unable to do this. So the importer may bear some costs in the sense he has to go to the customs port and, if they say, hey, these documents aren't good enough, then the importer may be in trouble. So those kinds of costs the importer might buy. So one might bear. So one might think that maybe if these products that are coming are very time sensitive, especially, then maybe the importer bears some cost in terms of meeting rules of origin. But in terms of providing the documentation and making sure that everything is, meets all the requirements, this has to come from the exporter side because the importer is not capable of doing it because he's not producing it. So at least our prior is that the exporter bears all these costs. But it would be interesting to see if there was any change in these costs depending on how the product varies and spillovers across products. So maybe like what you need to do for like t-shirts and for dresses is similar, but maybe what you need to do for t-shirts and automobile parts is very different. So t-shirts are likely to need less information, they're less complex than automobiles for sure. So that's something that we hope to explore in the future, but that's not the focus here.
Great, thank you, Kala. I also have a question related to the relationship between the size of the transaction and experience. And here I was wondering, there might also be an incentive to group transactions into bigger shipments, right? If you need to go through this process and bear this fixed cost transaction by transaction. So I was wondering if you can use kind of the size of the transaction and whether this got broken down into more or less transactions to also say something about fixed versus non-fixed costs.
That's a very good idea. So, I mean, we haven't done this. We could look at sort of a given exporter and say, okay, before the FTA, what was their average, what was the distribution of transactions? Yeah. And let's look at it after the FTA. Does the distribution of transactions change? And that's a very good
kind of number of transactions times average volume of the transaction.
Absolutely.
And the other question that I had that was slightly connected to the point that you were just covering is like how many products are they? Because I understand the two-way decomposition, but at the same time, if I only use one product, I will not be able to identify the effect of other products, the other products spillover in that specification. So I was wondering how much of this is coming from the fact that there are not really many other products out of which I can identify this spillover.
Yeah, I mean, if I don't have other products, it's not going to come into the estimation, right? So automatically it'll just drop out. So all the identification will be coming from exporters with many products, with many this. So you're absolutely right. This part of the identification is going to come from certain exporters, right? The other thing that I think what you said, which we deal with later, is, the fact that you could choose the size of your transactions means we need to worry about endogeneity. And that's why later on, we're very careful to provide an instrument.
Great. We had one more question by Lloyd Franzen, but I think you replied while you were replying to David, you already answered to this question, I think. But otherwise, Lloyd, please retype if the question was not addressed in full. Thank you, Kala.
Excellent. Thank you very much. Great questions. Yes. Okay. So now we say, okay, we see these as the patterns in the data, but should we interpret this as learning? I mean, well, we have luckily two kinds of variation, which should help us convince you that this is really learning. Okay, what are the two kinds of variation? Well, first, what we worried about and what I think everybody would worry about is, truncation issues. So supposing we take an agreement, it's been in force for 20 years. We have data on only the last 10 years. Well, how we start with the last 10 years. So when our time period begins, we don't know what experience the exporters have. So there's a truncation problem here, right? So you'd say, well, because of that, we should be seeing that experience matters less for old trade agreements than new trade agreements, because there's less of a truncation problem with new trade agreements. So this would say that, let's compare Argentina and Peru. Peru, this trade agreement's long-standing. For Argentina, it's new. So we should expect to see larger learning effects overall for Argentina than for Peru. And I'm going to show you that that's exactly what we see. The second thing, so I mean, this the sort of social learning idea that, if it's been around for a while, then, you sort of picked it up even if you didn't have a lot of learning. The second thing is a within country comparison. With Argentina, new products entered in 2005, first quarter. And, about 50-50 percent of the products covered afterwards were new. So newly covered products should have much larger learning effects because, hey, you by definition, you can't have had learning for these products earlier. So this is sort of our attempt to convince you that this really is learning, right? So I just want to show you that, the products covered increased quite dramatically. Okay, so the black line is the product share with some preference use. So these are sort of the products that were covered. And this increased after 2005 quarter one, phased in. So, there was some period when it was increasing. And now the value share, conditional on having preferences, rose, but more slowly. So this is what this table should be telling you. Okay. What about cross-country comparison results? Peru versus Argentina. Well, for Argentina, learning effects from the same product are larger than those for Peru. They're positive and significant learning effects for both countries. Experience with the same product and the same importer, for one experience, it's about the same in the two countries, 4.1 and 4.2%. But for 5 or more experience, it's 14.9% in Argentina and 8.2% in Peru. So it's roughly almost twice that in Argentina than in Peru. So, this is showing very clearly that you have much more learning in Argentina than Peru, and that's exactly what we had expected. The second thing is that learning effects from other products also exist, but they're positive and significant only for Argentina, and they're about 10%. They're not increasing with experience. So this suggests that these are one-off learning effects, not one-off. If you have experience, it raises the probability with other products of using it, but it's not increasing with the experience. So there's something that's in common, but it's not monotonic. Well, the second thing is if Argentina has larger effects because its FTA is newer, then the effect should be even larger for newly covered products. Okay? So what do we do now? This looks scary, right? Because what we're doing is we're introducing a new thing, which is a dummy, which says the dummy is 1 if the product you're exporting is newly covered. Okay? Then you say, okay, how do these new products differ in their learning? Do cross-product spillovers exist among the new products? So with the same product, there's no issue, but with other product experience, we break that other product. So supposing we have the same importer, but the other product. We break that experience into experience with the same importer and other product, but when the product this is newly covered, and when it was covered before 2005. So we have, earlier we have same importer, other product. Now we say, okay, same importer, other product, new, and same importer, other product, old. So the product could be new, or the product could be old. Okay? So we've this product old, new in 2 ways. One is the product you're exporting new or old, and then is your experience with products which are new. Okay? And this is saying, okay, without this dummy, you're saying, okay, we have possibly a different effect with experience in products that are newly covered versus products which were covered before 2005. And now with this dummy, we're saying, is this effect differential? when you're exporting a new product versus when you're not exporting a new product. So this looks even more horrendously ugly, but that's what we're doing. Okay? And so we test if the new product differs in terms of larger learning effects from the same product. Of course, with the new products, we have no truncation issues, so we should expect to see that. And cross-product spillovers with new products. So this is an example. So this is one of the places where we get something that we want to talk about. The other ones that we're not going to show, there's not much there, so there's no reason to show it. But let's just see what happens here. This says learning from the same importer, same product. You've got the effect when your product is not new. So same importer, same product. So there's no issue of new product, old product here. So with the same importer and the same product, we see that the effect is 0.6 here. But when your product is new, then it's more. This learning is more. So this is the additional effect of exporting the new product, learning. And the sum of the coefficients is what you get for the new product. This is what you have for the old product when you're exporting the old product. So what you can see very clearly is the effects for the new products are about twice that for the old products. And this is exactly what we would have expected. So moreover, they're increasing. There's this new effect, new product thing interaction is significant. And we see that it is learning with experience because these numbers are going up. So what about the learning effects for these old products? These are comparable with the effects for Peru. So this is sort of, for us, this was like, oh, this is, the sort of bloody knife that you're seeing in a murder story. So we were very happy when we saw this. We said, okay, now we sort of believe our story that it's because Argentina has more experience than Peru. Experience is more important in Argentina than Peru, and it's all coming from these new products. The reason they're different is because of these new products. So this is how we interpreted it. Learning from other new product experience, we see learning effects are mostly significantly positive for new products, but there's not much variation with experience. So this is sort of like a one-off kind of thing. Learning here looks like a one-off thing. The others, four, we're not going to show you because it's there in the table, and there's only so much abuse that you can suffer by being forced to see table after table. Okay. So we summarize what the overall results are. There's almost no learning from other old agreement products, no additional learning from other importers in the same product. Learning effects for old products are very similar to those for Peru. Any questions?
There are a couple of questions, but I suggest we leave them for the Q&A that we will have 15 minutes to discuss various.
Yes.
Yeah, great.
So now in the last part of this paper, I'm going to tell you about the things we worried about. Okay, what did we worry about? Well, we worried about the endogeneity of savings. Right? Julia's question very clearly showed why. So what do we do? Now, here finding an instrument was very hard because our data is at the transaction level. So the instrument should also be varying at the same frequency. So the only instrument that we could think of that would make sense would be the exchange rate. And we have, daily exchange rate here. And we use the 2-month lag daily Colombian peso exchange rate. And remember, we use this because that's a demand shock. If we use the Argentinian or Peruvian dollar exchange rate, that will also affect supply because it would affect costs if you were importing inputs. So we use this Colombian peso dollar exchange rate as an IV. Why? Well, the lag 2 months makes perfect sense because it takes roughly 2 months between the order and the delivery. So that's perfectly sensible to lag the exchange rate. And so you're making a decision on the order based on, a 2 month earlier from the time of the transaction. It hits the port and comes through. As I said, we don't use the exporters one because it's not exogenous. Because it'll affect the cost of using preferences, it'll affect its use, and so clearly it's not exogenous. Okay. What do we find here? Well, the savings, when you think about it, you would say, look, you need to be very clever here and very careful here. And cleverness and carefulness came only after we had a little experience in doing this. So what do we see? We need to worry about the fact that savings may be less important for large transactions. If your transactions, a few $100,000, or 200,000 versus $300,000, possibly savings are not going to matter much. But if your transaction is 5,000 versus 20,000, savings is going to matter a lot more. So we consider an interaction with the large transaction dummy, and we would expect that the large transaction dummy, you're going to have a smaller coefficient on the savings. Moreover, we've seen that experience tapers off. It's not that valuable. More experience is not that much more valuable once you exceed a certain level. So we focus on the first 30 transactions of the exporter only. Moreover, then doing this, we look at what the results are with the OLS and the IV using the same data. And we find that, yes, the coefficient of the savings variable changes, but the learning effects from the same product, importer, and actually all the others, they're pretty robust. So the tables are in the paper, and we also do this for Argentina separately and Peru separately. And it's not like there's a lot more to show other than the result that the IV estimates for learning look very similar to the OLS estimates for learning. The savings coefficient are quite different. All right. So I suggest you look at this carefully to convince yourself, but it would take about 5-10 minutes to really see, okay, this is a horrible table. How do I look at it? So this is, I'm just sparing you that pain and telling you about what the results were here. Okay. The second thing is, remember I told you what the variable was. It was the difference in the tariffs times R0, which is the revenue or the value of the transaction when you don't use preferences. But what do? We actually are using the information on the value of the transaction in the data. Well, if you're using preferences, that will be R1. If you're not using preferences, it will be R0. So there's some mismeasurement here. We should be using R1 when preferences are used, and R0 when we're using R1 when preferences are used and R0 when preferences are not used. But the model says you should only be using R0. So we have measurement error here. And that measurement error, of course, is going to cause us some issues because the measurement R0 versus R1, that's, well, are you using preferences or not? And because of that, you're going to end up having an endogeneity problem. So the error term, which is what we're mismeasuring, is going to be correlated with using preferences or not. And so, well, that's a problem, right? So what do? We use the fact that we know the form of this mismeasurement. So when we do that, we can rearrange the equation and show that the exact form in which we're going to be getting biased estimates is the following, which is all the coefficients are going to be the true coefficients divided by 1 plus a positive number, which means that our coefficient estimates, because of this mismeasurement, are going to be biased downwards. But what are we interested in? We're not that interested in the savings coefficient here. We're interested in the learning coefficients. So the ratio of the learning coefficients should be unbiased. So the fact that the learning coefficients are falling over time, the effect of more experience is decreasing over time, those ratios are completely unbiased because of this measurement error. So what the focus is for us in this paper is those coefficients. So if you think this measurement error is a big deal, don't look at those estimate levels, look at the estimates relative to one of the estimates. And that's going to show you that the pattern that we've been plugging in throughout is still there. So we were quite happy that we could actually show what this measurement bias would result in and show that, despite this, we could still interpret the coefficients the way that we are. So, we show that, this attenuation bias is there. And, but the pattern of learning with experience that we've been pushing is there. Okay. Well, that's basically what I have to say, but I'd like to talk for a few minutes before we end about what our results mean and why we should care about them. Well, our results show that imply that FTAs should further disadvantage smaller firms. We know that because they're fixed costs in exporting, smaller, less productive firms are going to be disadvantaged in exporting. But with these rules of origin to be met and these further fixed costs that go on, and these fixed costs, they're going to matter more when your transactions smaller, when you make fewer transactions because you learn less. So we think that one very interesting angle to explore is, are FTAs really disadvantaging smaller firms? Can we document this very clearly? And if so, how much? What are the consequences of this? Is this going to restrict entry into exporting ex ante? How much would this be? But this would need a structural dynamic model because these are learning and experience a dynamic issue. And these are things that, should be done. Because of this also, FTAs, because their presence could result in greater monopolization. If larger firms are the only ones doing this, then hey, they got more market power, there are fewer firms there, less competition. The final thing is, we think of trade agreements in static sense. Almost nothing is done thinking of trade agreements in a dynamic sense. And we need to change that thought process. We need to start thinking trade agreements dynamic, always look for dynamic implications. What about the future work? And I promised that I would tell you about this. So this is part of a larger project. And, this is a gold mine, the data that we have with Christian in the Inter-American Development Bank. So, we are working on 3 things. The first is we're developing a model-based method to estimate the restrictiveness of rules of origin in terms of their marginal cost. And existing work on this, Tony Estevardo has a very nice paper, but it's qualitative. So what you do is you say, okay, these are the rules of origin. Are they on this, of this kind or this kind? If it's this kind, it's +2, this kind is +1, and construct an index from this. But it's not really model-based. And we think with this data, we can actually construct model-based measures. So this is a big part of our ongoing research. Then we need to model this dynamically, and we're developing a simple structural model with dynamics to understand the policy issues here. And lastly, we have evidence that nonlinear pricing and bargaining are prevalent at the firm level in international trade. Recent paper by Kikawa, etc., also has nonlinear, has bargaining, but not nonlinear pricing. And this is neglected in most existing work. And it has implications for many things, like productivity measurement. So if your larger firms are getting cheaper inputs, given that we use RTFP, revenue-based TFP, we're going to be mismeasuring productivity, saying these guys are more productive because with less value of inputs, they can make more outputs, but they're getting less value because they have lower prices facing them and because they have more bargaining power, and not because they're more productive. So, these are three angles that we're working on just now. And with that, I'm out of time, and I thank you.
Fantastic. Kala, thank you very, very much. We have already a few hands up. So starting with Jonas Kasteng, I will unblock you. So Jonas, you can now unmute yourself and ask your question to Kala directly.
Thank you very much. Can you hear me?
Yes.
Yes, we can hear you.
I think you have made a very interesting research at the National Board of Trade Sweden. We are working on the same paper based on learning.
I'm sorry, you're breaking up.
Do you hear me?
Yeah, barely, yeah.
Okay, I will try to speak close to the microphone here. At the National Board of Trade Sweden, we are working on a similar paper, but we have an importer perspective. We think that according to our understanding and contact with importers and exporters, normally the importers are the ones that drive the preference utilization. They are the ones that normally request the preferences to be used. They benefit from the duty savings, and they are the ones that take the risk in case of something is not in order. So I would like to ask why do you have an exporter perspective in your study? Of course, this might depend on Incoterms as well, but in general, we have the opposite approach. Thank you.
Yeah, that's a very good question. So I think the reason we chose to think about it like this is the importer can request this, but who's going to bear the cost? It's the exporter. The only cost that the importer might bear would be, well, the paperwork gets screwed up, it can't come through customs. So that's why I was saying that, importer cost borne would be more for time sensitive material. And that's how we can think of cost being there for the importer, but for the doing of the thing, it's the exporter who does it, which is why we say the exporter puts that into his calculations when he's setting his price. So you're absolutely right. The importer may say, oh, okay, I want you to use preferences. Okay, and if you're using preferences, then the exporter will say, okay, if I'm using preferences, then this is my price, because my marginal costs are going to go up by this much, and I have to do this, and I'm only going to do it if you have a large enough transaction. So that's sort of my English answer to your question. I hope it makes sense, but I don't think this invalidates the assumptions that we made.
That's very clear. Thank you, Kala. Next, we have a question by Monica Mrazovat, and we also have a couple other questions. Monica?
Yes, Kala, so this may be a silly question because I was a little bit distracting with answering to all the different questions. So if I missed this in your talk, sorry, but I'm curious about, so you show how the usage of utilization of preferences varies as a function of experience and as a function of the volume of transaction. And you had this savings measure. So can you also, or do you also look at, so if you have the same size of transaction, but just the preferential margin is larger, do they also tend to use it more than if so just by looking at the difference between the MFN tariff and the tariff that they can get when they use the preferential?
Well, we should do that. We didn't do this in the regression that we have because the regression sort of came from a model and the model said that this is what you should be using as the savings variable. So we didn't look at it separately, but that's definitely something we could very easily do, and we will do, and see if the correlation is there. controlling for the size of the transaction, does the tariff margin matter differently than the size? Okay, thank you.
Fantastic. We have a hand up. Theodora Tetti, I am allowing you to talk. If you can just unmute yourself and ask the question.
Hi, does it work? Yeah.
Yes, it does.
So my question is basically how, because in the beginning at your motivation, you were distinguishing between these two types of costs, right? So you were talking about this reorganization of global value chain. I think that's also what most people tend to have in mind when we talk about rules of origin, or at least like a lot in the current debate. But then I think in your context, as we're talking about Latin American countries in the midst of 2000s, I don't know if these countries actually have long value chains, so long and complex value chains. And if they don't, then what you're actually speaking to is not so much this reorganization of global value chains, but instead mostly these other aspects, right? So these aspects of like admin costs and like learning how to actually fill out the forms and so on. So I don't think it's an issue, but it would just be nice to, I mean,
yeah,
it'd be cool to have both, but it's kind of hard.
We actually have sort of the data that we could try and separate these two. Is it, global value change and redoing your supply chain, or how much is something else, right, which we call documentation? Yeah. So, I mean, we could look at this across products which have a complicated supply chain where you have to change things or not. And, we could definitely try and do that and try and understand more about this. So that's a very good point. That's why we don't say what it is. We say it could be this, it could be this. And we don't take a stand on what it is. We sort of talk more about global supply chains here because people say, look, how much can this documentation cost? Well, it could cost a lot if you've got to go to every single supplier and you've got many, many suppliers for your product, for the inputs for your product. Hey, this could be majorly costly, but we know about the product too. So, we could try and construct some index of sort of how complicated the supply chain is. But then we also need to have some index of what the rules of origin would imply for your changing of the supply chain. And that would be much harder because that would mean we would have to read each one and say, okay, this one, they've got this supply chain. And then for this one, I mean, that's not going to be doable in finite time. We might be able to do this for a particular example, take one product and another product is the exact opposite and compare them. But I think that that's probably all that we would be able to do. But if you have any other suggestions, I think that would be brilliant.
Great, Carla, thank you for that. I had also a couple of questions out of curiosity more than anything else. So one was, if I were to look at as an outcome, the switches of origin for, this is very related to the point that was just made. If I were to put that on the left-hand side of a specification similar to the one that you are working on, so switches of origin for a given input, do you expect to see that changes in rules of origin do a lot in the extensive market? So that's one question on the left-hand side. And a different question is whether, or a related question is whether your framework with constant markups gives you a prediction on prices. If you were to put prices on the left-hand side, then then probably you can say something more about these issues on costs, fixed costs, and non-fixed costs, and pass-through on prices.
Yeah, I think those are both very good, Chris. So in answer to the first one, I think that's partly the point of Paula's paper and Mark's paper.
Yeah.
Right. I mean, Paula shows very clearly that the sourcing changes quite dramatically. Right. And so I think, yes, depending on the FTA, you will get, you could get very large changes in sourcing and in your supply chain. With respect to the second thing, yes, price does seem to, in our initial things, it does seem to follow this, that, price is higher when you use invoke preferences, and that makes perfect sense. Whether it's because of, price are going to be higher anyway, right? The price is monotonically related to cost. But is it the CES thing or not? We haven't tried to actually estimate this, because I think the only way we could really be sure that we were getting this would be to take a particular product, do the dynamic structural estimation, and then check whether the price changes corresponded to the CES, constant markup framework or not. And look, the world is not CES. We know that.
Yes.
We know that. We keep using this as a easy way to get the model to be built. But I'm not really sure what we would learn other than what we have in terms of modeling it in a more complicated, less easy to deal with way for this problem. So that's why I'm like, okay, fine, CES is okay. I'm not going to lose sleep overnight, at night over whether we're doing this or not.
No, perfect. And understood. It was more out of curiosity.
No.
How it looks in your
know
data.
Where you're coming from, because I also, I look at the CES models and I'm like, depending on the problem, it keeps me up at night or not, right? If my results are going to be all dependent on the fact that I chose CES, like, okay, to take a cheap shot, we have these lovely models which tell us what gains from trade, right? There's a huge gain from using CES there, right? But we know very clearly that, hey, that's unlikely to be true, especially when you have inputs. If you have an essential input, you could have massive losses from closing up. So maybe in some contexts, you should lose sleep over it at night. In other contexts, maybe you should not worry so much. But
yes. That makes perfect sense. We have 2 minutes, Carla. Can you take one more question from the audience?
Of course.
Okay. Loe Franzen, I am blocking you to talk. If you can unmute yourself and ask your question.
Can you hear me
now?
You're a little faint.
Let me try to speak closer
to the
microphone.
Much better.
Is this better? All right.
Yeah.
Much better.
First of all, thank you very much for the very interesting presentation. I work at Statistics Netherlands, and we're also looking at import or preference utilization, specifically in the case of Canada and now with the United Kingdom in the Brexit scenario. And we just have the import side. So it's very interesting to hear this, import-export information, because I really think that's where we have to go in order to explain these determinants of preference utilization better. So I'm very interested in the paper. My specific question right now is about rather than the costs of preference utilization, have you also looked at the heterogeneous benefits of using a preference, a trade agreement? So if we think of the pass-through literature, a trade agreement can make, the tariffs cheaper. And could you look at whether it's then the importer or the exporter that benefits particularly from, this becoming cheaper? And that relates also to some of the earlier questions on who bears the costs or the benefits of an agreement, who has the greatest incentive to make use of the agreement. The pass-through literature, as far as I know it, it's often the importer that bears the majority of a tariff. So wouldn't he also bear the majority of the tariff, the liberalization? And what are your comments on that?
Yeah. Okay. I think first it's very dependent on two things, right? One is the product itself. We know that there are one set of results when you have perfect competition, infinitely elastic supply with pass-through, and you have another set when you don't. The second thing is, it depends on, and we've seen that this is true. Like, for example, with the US-China thing, China is basically at razor-thin margins, all right? They can't really change their price very much because it's not like they've got any profit to give away, right? And that's what we see in the trade war things. When the US puts a tariff on, they just raise their price because there's nothing to give away. So this is sort of in my mind at least, very convincing evidence that which way the pass-through works when you have tariffs, etc., they're very dependent on how much, on the situation. China is super competitive. It's not like they're monopolizing the world, at least in rare earths, yes, but not in other products. So in many of the manufacturing products, I don't expect if you put a tariff, you're going to get huge, large country gains. Secondly, when we think about seeing who gets what from invoking rules of origin, how is this reduction in tariff shared between buyer and seller, we can do that. And we have the kind of data to do that. We would like to do that, but I think that's like number 4 or 5 on our list. So we have, we think we have like nice theory and nice results for the 3 things I told you about. And while this is, I think, fascinating also, there's so much work on pass-through that this would connect to that we sort of thought, well, maybe this is 4 onwards. We won't do it just now, but you're very welcome to do it. We don't claim, we're holding on to this one.
Fantastic.
I hope I answered your question.
Yes, thank you.
Okay, thank you.
Great. Kala, we are a few minutes over time, which happens when you have a super exciting paper and all of us have many questions. Thank you immensely again for your great presentation. Thank you as well to Yuta and to Christian for joining us today, and to the audience for being here and for your participation. We will meet hopefully all of you in a couple of weeks for the final GTW session of the semester. Kala, once more, thank you very, very much. It was fantastic to have you.
Thank you for having me. It was my pleasure.
Thank you. Bye-bye.
Bye, everyone.
Bye.